Good morning and welcome to this chapter. Again, business valuation. We are taking special cases. We have discussed non-going concern, distressed companies. Now we are studying valuation of startups. Under that, we have seen Burkus approach, cost to duplicate approach, comparable company transaction, scorecard valuation method, and now the next is first Chicago method. First Chicago method, this method combines discounted cash flow approach and market approach. This method combines discounted cash flow approach and market approach to give a fair estimate of the startup value. So it's a mix of discounted cash flow approach and market approach. So under this, they will compute the value of the firm by taking worst case scenario, normal case scenario, best case scenario, and then valuation will be done by assigning probabilities and arriving at weighted average value. For example, they will compute DCF in a worst case scenario. What can happen? What will happen if the situation is worse? Let us say cash flow may be 200 crore. Normal case 400 crore, best case scenario 600 crore, and you assign probabilities as to what is the probability of worst case scenario. Say for example 0.5, 0.3, 0.2, and then multiply the cash flow into probability or DCF into probability. What is the answer? This is 100, this is 120, this is 120, and the total is 140. Total is 140, and that is how the first Chicago method would be applied. If you remember, in the capital budgeting chapter, we have done scenario analysis where we have computed DCF under different scenarios. Here, instead of project, it is a business, and you do the same exercise, multiply by probabilities, that will give you expected weighted average value. Next is called venture capital method. So what is venture capital method? This is the method used by venture capitalist. This method is used by venture capitalists, and they have made this method popular. The venture capitalists want a return in multiples. They say that we are investing 100 crore. After 5 years, we must get 10x, 10 times of our return. So 1000 they expect after 5 years. Venture capital expects, let us say, 10 times of their investment. So after 5 years, 10x, and then you compute the present value of this 1000. Compute the present value of this 1000. That gives you the value of the firm today. Such investor means venture capitalist. Venture capitalists are the investor who are willing to take high risk for a very high return, seeks a return equal to multiple of their initial investment. So they are investing with the hope that they are going to earn 10x on their initial investment, or will strive to achieve a specific internal rate of return, or they want to earn a very high IRR. Let us say they want to earn a IRR of 30% based on the level of risk they perceive in the venture. So this is venture capital method, where they calculate what will be the amount they will realize after a certain time period based on multiple or IRR. The method incorporates the understanding and uses the relevant time frame in discounting a future value attributable to the firm. The post money is calculated by discounting the rate representing an investor's expected or required rate of return. So we are here, we have invested an amount, we'll calculate the value here, which will be some multiple of initial investment, and then this will be discounted back to give the pre-money or post-money value. So that gives you post-money value. Post-money value means after making the investment. After making the investment. The investor seeks a return based on their multiple of investment. For example, some investor may expect 10x. 10x means if you invest 100, you expect that the value after a given time should be 10 times of your investment, that is 1000. If you invest 20x, then you expect the value to be 2000 rupees of their initial investment at the time of exit. So this is how the valuation is done. This new age startups means what you see nowadays, new companies coming up are disruptors in their own right and necessary tool for global innovation and progress. So these new companies are required to be funded because they can bring lot of progress, change in the way things have been done in the past and can be done in the future. For example, there is artificial intelligence chatbot now called ChatGPT, where the valuation has gone above how many dollars? I think more than $10 billion. The valuation has gone up, and this is a very amazing startup because it helps users to get answers to any type of their queries immediately, and it can do lot of tasks which you were earlier doing, say, manually. And therefore we need to value such companies properly. By their very nature, startup disrupt the set process and industries to add the values. So I am going to give you a small example on venture capital method. Would you like to write down? If you like to write down, then I will give, otherwise I will not. So do you want to write down? Right, very good. So write example. This example is just for understanding the concept, not for the exam purpose. Not for the exam purpose. I try to find out examples if I can. Right now the study material does not have too many examples on this topic. Write down exit multiple. Exit multiple. Exit multiple means when the venture capitalist will exit from that venture, how much multiple he is looking for. So let us assume that industry standard exit multiple, let us assume that the standard exit multiple for similar startup is 5x the projected future revenue. Projected future revenue, assuming that you project the startup to generate $10 million in revenue, in the 5th year. Then write down required rate of return. The required rate of return for the investor, which reflects the expected return on investment, and the level of risk is 30%. Assume a venture capitalist wants to invest $2 million. Assume a venture capitalist wants to invest $2 million. Calculate pre-money valuation. Calculate pre-money valuation. Before putting this 2 million, what is the value of this business? Now this person wants to invest. What is his exit value? His exit value, he thinks that he can exit at 5x of the projected revenue. You can exit from this business at 5x of the projected revenue after 5 years. After 5 years, the projected revenue is 10 million, which means the exit value will be 5x into 10 million, 50 million. The exit value will be 5x into 10 million, 50 million after 5 years, which you will discount at 30%. You will get present value, and from that present value, you deduct this $2 million, and that will give you pre-money valuation of a startup. So good question. Write down answer. Answer, write down. Present value equal to, so this is 5x, this is 10 million. So 10 million into 5, 50 million. 50 million divided by, because the risk is very, very high, the venture capitalist will be using a very high discount rate. The venture capitalist will be using a very high discount rate, that is 30%. Now please do the calculation and confirm if the answer is right. Is the answer right? 20,91,055. Please answer. Is it right? Just check. I have not checked. You have to check and confirm. I am also checking. Is the answer right? I have a doubt. What is the answer? Yes. I am getting 1, 3, 4, 6, 6, 4, 5, 3. Can you check again? Can you please check again? Can you please check again, everybody? We don't want to go with wrong answer. Type 50 million. Type 50 million. Divide by 1.30. Press equal to 5 times. So that comes to 13466,453. Now write down pre-money valuation equal to present value minus investment amount. Present value minus investment amount. So present value is 13466,453 minus 2 million. Minus 2 million. And that is equal to $114,66,453. That will be the answer. That will be the pre-money value. This fellow brings in 2 million and this is post-money value. Okay, so this is how this venture capital method will be applied. These are some methods for valuation of startups. This list is not exhaustive. There are innovative methods going on the basis of which startups can be valued. Now we'll come to next part of this chapter, valuation of digital platforms. Valuation of digital platforms. Now you see around you, you can only observe there are different types of companies selling their products and services on website. So that is a digital platform. It is a software based online infrastructure that facilitate interaction and transaction between users. So any website you imagine, for example Amazon, where you purchase so many types of goods. So that means you go there, you choose the product, you make the payment, and then the company arranges for dispatch of goods. That's a digital platform. Or for example, you can go to Make My Trip website and you can book hotels, airlines, like that. Okay, you can go to our website and you can place order for any educational lectures or books. So these are digital platform where you can interact with the website and you can even do transactions with the websites. And there are different types with different objective. The principal platforms are built to facilitate many to many interactions also. Large number of customer can interact and the supplier can cater to a large number of customers at a time. Many times many people can interact with each other also directly. Like for example Facebook, okay, WhatsApp, you can have group chat also, or your Instagram. I don't use much of this thing, but still people use it, and therefore you have to understand that how these companies are valued because of the benefits or the services they provide to the customer. Some of the digital platforms are mentioned in the book, like digital platforms acts as marketplace where buyers and sellers both will be interacting with each other, or they will come to this place. The seller will sell his product, the buyer is going to buy his product there. A simple example is booking.com. So all the hotel company will list their hotels there, all the airlines will list their businesses there, and at the same time the customer can go there and book the hotel tickets, airline tickets, or whatever. And then another example is this Uber. Now you are person who wants to travel, you are a traveler. There are lot of cab owners who are looking for customer. What Uber is doing, it is just trying to bring the cab owners and the travelers. So it is acting as a marketplace for them. And the best example is Amazon, where lakhs of sellers have registered and they are selling their product through Amazon, and lakhs and crores of buyers are using the platform. Okay, so that is called marketplace, where sellers can display their product, buyers can purchase those products, and all this is happening now online. Should I tell you about search engine? You know more than me. Every day you use search engines like Google, Bing, Baidu. Maybe I don't think you use this Bing and Baidu more, but they are also search engines where people are searching for information, and the search engines are designed to provide the desired information within fraction of a second. They are called trust search engine. Then repositories. The most popular is Spotify, YouTube, GitHub. So where they have collection of music, songs, videos. So it's a repository. That is, suppliers deposit their material into a type of library. The suppliers deposit their material into a type of library and which is accessible by the users. Some of them may be free, some of them may be paid version. So like for example in YouTube we have uploaded our video. So it is for free. So any student who wants to watch the video can watch those videos. So this is an example of repository. Do you know some more example? I think that Ghana.com is also there. Ghana, Savan, and so many, where you can go access and enjoy either movies or songs like Netflix, Amazon Prime. These are repositories only where you have documentaries, movies, and so many things of your interest. Then there are digital platforms which create digital community. Oh my God, like Facebook, where people communicate with each other digitally, virtually. They can talk to each other, they can discuss, debate, okay, share pictures, videos, all digitally. The best example is this Facebook, where people can create a network of their friends, or another example is LinkedIn. These are example of digital community where people with similar role in business, they come, they form a community, they discuss ideas, discuss business, and discuss things of common interest. Another highly popular digital platform nowadays is payments platform. Google Pay, Phone Pay, Paytm. These platforms allow you to make payments. Those who want to pay, those who want to receive, they are connected through this payment platform, and this has really made a revolution in the way transactions were executed. People now spend more money than they used to pay earlier because it is very convenient to make the payment. You will just scan the QR code, payment is done. Government is also interested in promoting such payment platform because more and more transactions if taking place on digital platform, government can keep a track of the transactions, less physical currency would be required, and these payment platforms, they become bigger and bigger because more and more users join this platform, and then they do cross selling. They will sell insurance product on them, they will sell some movie tickets on them, they will link it to their merchandise warehouse where the customer can buy, and the data that they get, that data they can use for marketing and other things. So this is how these payment platforms work. Our topic is valuation of startups. Today our topic is valuation of digital platform. It is similar to startups because many digital platforms are also startups only. Many digital platforms are also startups only. Paytm was also a startup. This Phone Pay was also a startup. This Book My Show is also was a startup only, and so many. Flipkart was also a startup. So they have given some methods, but unfortunately there is no numerical example. So we have to only discuss the theory today. There is no choice. I can give you brief idea. Some of these methods you are already well aware. They have only repeated the same model again for digital platform also, like income approach, cost approach, market approach. It's already discussed under other heading also, It was discussed in the main chapter also, business valuation. So principle of valuation of digital platform are not very different from other types of companies, are not significantly different from other type of companies, but of course this digital platform also have some peculiar feature which one has to understand, and based on that the valuation can be affected. Fundamentals of the valuation remain the same, whether it is digital platform or any other platform. As a valuer, the important thing for you is to understand the business model. Whenever you can understand the business model, it becomes easy for you to value the particular business. Even if it is a digital platform, what is their source of revenue? How the revenue is generated by them? What are their costs? Then what is the quality of the management? And understanding various risk reward parameters. Different digital platform can have different risk reward parameters, and accordingly you have to incorporate them in your valuation, right? For example, in such businesses competition is very high. Unless you scale up to a very high level, enormous level, like Google search engine, the competition can be very high in such businesses because easy to replicate. Your model is easy to replicate by others. Let us see the method number 1, income approach. So what does income approach means? The valuation is based on the future income of that platform. The valuation will be based on the financial performance of the platform. You have to estimate future revenue, future cost using company specific revenue and cost driver. Also take into account future capital expenditure and working capital requirement, and then you do the valuation. We don't have too much of information in the study material, but it is like your other models only. You can use FCFF approach also here, where you will write NOPAT minus net investment, or you can use future maintainable profit divided by capitalization rate. So under income approach we can use this. We don't have past data, we don't have too much of past data. If you have past data, then you can capitalize past profit also, or average profit divided by K if you have past data available. That is how the income approach will work. And these models we have already tested or applied in business valuation chapter. So if you get question with similar sort of data, you follow the same methodology. Second method which they have said is called top down approach. Top down approach means you first look at the whole industry. What is the size of the industry? Top down approach, size of the industry, which in their lingo they call it TAM. Sir, what is TAM? Total addressable market. Total addressable market means what is the size of your industry? What is the size of your industry? How many people will use Netflix? You have to visualize. How many people use online platform for watching videos, movies? That is your TAM, total addressable market. That is how many potential customers are there which are going to use this particular service, and then out of that you have to estimate your share. Your share. How much share you will get out of it? Let's say your share is 10%. Total size of the industry multiplied by your share means this is the revenue you will be able to get out of this entire industry. That is called serviceable addressable market, SAM. From TAM you have to move towards SAM. The next step is to estimate the share in this target market the company estimates to gain in future and the time to reach such share. So first of all, what will be your share and when will you reach it? So you have to keep on estimating what will be TAM, because this TAM will keep on changing also. Certain industry will keep on growing. The number of people watching online videos is growing like anything. Maybe in the first year 20 lakh people were using online video. After 5 years they believe 100 lakh people will use online videos. Then you compute SAM, what is your market share out of it, and serviceable obtainable market. So you have to find your market share, which is called SAM. TAM is total, SAM is your share in that market or serviceable obtainable market. Company then needs to estimate its business plan to accomplish its objective and strategy. So you are going to achieve suppose 10% market share at this point. After 5 years you will be able to get a pie of 10% in next 5 years. How are you going to achieve this? That strategy you need to identify. And then they have given lot of information which is actually not related to valuation, but they are talking more about how the digital platform works. This would involve estimating the manner in which company will gain market share and increase its revenue and optimizing cash or utilizing cash. So basically how the business model works they are explaining, and as a valuer you have to understand the business model. The financial forecast should take into consideration the type and feature of business model of the platform. So very important, understanding business model is important so that you can make projections about the future cash flow. A digital repository like YouTube, Spotify, which allows streaming of content, may earn revenue based on its subscriber. In case if you have to value a subscriber based service, make projection about how many subscribers you will have. Suppose you will have 100 million subscriber, then you have to estimate what is the average revenue you earn from each subscriber. Let us say they, in their language they call ARPU. Have you heard ARPU? Average revenue per user is suppose 200 rupees. Then your total revenue will be 100 into 200. That is how the projections are done in case of digital platform. If it is a subscription based service, estimate the number of subscriber, estimate the average revenue per user. That helps you to estimate the total value or total revenue. The direct operating cost for this platform will also be unique. So instead of giving us how to value, they are just giving us knowledge about digital companies, which everybody knows that every company will have a different business model. So their operating cost can also be different. The operating cost will also be different. Then they are also explaining, which is not relevant, how this digital platform achieve a market share, how they increase their market share. Everybody knows nowadays, a 10 student also know that they are trying to popularize their platform by giving lot of discount, okay, payback, cashback, vouchers, free gift item, massive advertisement, cash burning, and that is how they are going to project or increase their market share. It is believed that if you burn cash today, it is only for few years, because once the platform achieves stability, the cash burn will reduce. The cash burn means the cash losses will reduce, and finally you will become profitable and reach a stable growth rate. That is the assumption in case of many startups as well as digital platform, that cash requirement will reduce with time as profit margin becomes stable and rate of reinvestment reduces. So this is called top-down approach, and it can be very ambitious for a new company. New companies are very ambitious. They will project to the venture capitalists like this. They will say, sir, this is India. India is a huge country. More than 145 crore people stay here. So even if we capture 2%, see how much will be my serviceable, addressable market. 2% of this is the story they have to create. Okay, these venture capitalists like good stories, and then they are willing to get fooled. So you will say we will have 2.9 crore subscriber, and India is getting more and more digitally alert or literate. Even watchman, driver, illiterate people, village people, they are watching videos on mobile phone. So please give us money, and we are going to make this platform one of the India's biggest platforms. That is too ambitious. But as you grow ahead, the challenges will come. So that was about top-down approach. Top-down approach means you first find out the industry size and your share in that. That is top-down approach. And then you do the valuation based on your share. Bottom-up approach means you don't look at the industry. You look at how much revenue you will be able to generate. You know your limitations. Okay, that I will be able to generate so much revenue at so much cost. So under this bottom-up approach, we don't take the total industry size, our share in that. We simply calculate how much earning we can earn based on our resource available. Okay, and estimate your revenue and cost based on your financial resource, human resource, technology resource that is available. The promoters of such platform can deploy appropriate strategies to target high margin sales and cost cutting methodologies to generate more cash flow from the platform. So what they are trying to increase the profitability, focus more on high margin sale and reduce the cost, and based on that they will project their future cash flow. So this is more in line with market efficient capital budgeting decision, which will ultimately help to forecast earnings and cash flow. So I have nothing much to explain here. It is simply the projections are made based on the resources that is available. That is bottom up approach. Start from the lower level, how much I can make out of it. Both the approaches, the value of digital platform will depend on the quality of the financial forecast. Very well said. Valuation will depend on quality of the financial forecast. Better the forecast, more objective information you gather, you will get a more appropriate valuation. But as we know, valuation of such digital platforms are highly subjective. Which discount rate to be used for valuation? The discount rate we use for valuation depends on approach we are following. If I am following FCFF approach, then I will use WACC. If I am using FCFE approach, then I am going to use cost of equity. Sir, what are these items? FCFF, FCFE. Please refer our main chapter, business valuation. Okay, and the cost of equity will be calculated using CAPM. Here usually the beta is very high because risk is very high, and that is why the discount rate used for valuation of digital platform can be very high. With respect to the valuation of digital platform, some care will have to keep in mind. For example, beta. Beta is the measurement of sensitivity of a stock or a company to that of the market. But in case of digital platform or in case of startup companies, the risk is very high. The risk is very high. So therefore, we have to really take a higher beta before we can do the valuation. And the second thing we have to take care, the probability of survival of such digital platform. Every day I will tell you thousands of new digital platform appear on the scene every day, because making now websites have become very easy. They teach in the schools also how to make website. So at least some basic website even a 10th standard student can create, right? Of course, if you want to put lot of advanced feature, some more specialization may require. But then making website has become easy. Making apps have become very easy. But are all these digital platform going to survive? So while doing valuation, first thing is about discount rate, it has to be on a higher side. Second thing is about the survival possibility. Whether this will survive depends on quality of management, adaptability to change, and foresee the opportunity. If the digital platform founders, promoters have these qualities, their chance of survival is more. Okay. There are certain specific risk of digital platform that cannot be estimated using CAPM with regard to only the industry or general sector beta. So these are the specific consideration kept in mind while valuing digital platform. Discount rate should be higher. Probability of survival you have to see. While computing the discount rate, one has to also look at company specific risk premium, CSRP, because it can vary from company to company, and for some businesses the cost of capital can be very high. So therefore, if you find a particular company to be very risky, the premium to be added to your cost of capital will be very high, and that is what they have written also here, that this premium will be very high for new companies. Nascent company means new companies, but premium will be lower for mature digital platform. Mature digital platform law, for example, Netflix is a mature platform. Globally now it is accepted and it has got a stable revenue, stable customer base. But if a new company comes tomorrow and starts providing the similar service, we don't know whether it will accept, whether the market will accept it or not, and discount rate to be used is very high. So that was about top down and bottom up approach. Care to be taken, discount rate is very high, probability of survival you have to see, company specific risk premium has to be taken into account, which can vary from company to company. If they ask you FCFF model, we have already discussed. So they can give you a question based on FCFF model, already covered, or FCFE model, already covered. But while using discount rate, just be careful. The third one is called market approach. Market approach means find a company which is comparable company. Sometime you may or may not get a comparable company. If a comparable company is listed company, then your life is easy. Okay, your comparable company if listed, your life is going to be easy. So some companies, let's say for example, yatra.com has got listed, and there may be another company, let us say Go Ibibo. They are all into hotel booking, airline booking, bus booking, train booking, like that, holiday booking. This is listed company, this is unlisted company. Go and take the P ratio of this company and you can apply it to this other company, subject to their profit should be positive. Profit should be positive. Or you can use, which is more popularly used compared to this model, because by the time you compute earning after tax, it becomes negative. The problem with many digital platform, they are still into losses. After 5 to 10 years of their operations, they are still into losses when it comes to earning after tax. But some of them are EBITDA positive. Some of them are EBITDA positive. So if it is EBITDA positive company, one can apply enterprise value to EBITDA ratio and do the valuation. Or you can apply price to book value multiple. But all this will require that there must be a comparable company, or there are 2 or more comparable companies whose average can be taken for the purpose of valuation. Or you can use, if suppose you don't have EBITDA positive company also, then nowadays there is a valuation game going on which is based on price to sales ratio. That means if you have a sale of 2 crore and the multiple is 5, your company will be valued at 10 crore, even though your EBITDA may be negative, your earning after tax may be negative. But yes, the investors are putting their money on the basis of only sales, and that is why every damn company is trying to promote their sales like anything. They know that my valuation is not based on my profit. Profit is the last thing in my mind. The only thing I want, sale, sale, sale. So continuous advertisement, discount scheme, cashback scheme, gift offer, so that their top line will increase. How to select a similar valued company? If you are using a comparable company approach, then the company that you are going to select for comparison purpose, you have to look at their market capitalization. It should not be too different, or their revenue. One company to be valued has a revenue of 2 lakhs. Other company is having 20 crore rupees revenue. Difficult to compare such companies with so much of difference. Profit margin, capital structure. So the comparable companies should have common features. Of course it cannot be equal, but at least it should not be very, very different also when you are using comparable company approach. And even if you are using it, then you will have to make adjustment to the valuation. Then you will have to give some discount when you value this company, because this has reached a customer base, stability, it's a listed company, okay, it has a positive cash flow, and if you are using that company, then you have to give discount while doing valuation of such companies. So that is how the valuations are done. Next is, what are the difficulties in applying comparable company approach? for valuation of digital platform, this we discussed earlier also, that when you are using comparable company approach, there are certain challenges. For example, the listed comparables are rare, scarce. You may not find a comparable company which is listed on the stock exchange. Is it right? How do you value them? Then they are even absent for many platforms. Some companies don't exist only on the stock exchange, and sometimes there is no comparable company only, whether listed, unlisted. Then the underlying value specifically profit and EBITDA may be negative. Oh my God, the company you want to value has a negative earning before interest and tax, negative profit, and how do you compare them? Such digital profits are capital light, making their book value also very low. So if you want to apply book value multiple, that is also not appropriate, because this new company, digital companies, may not have assets. The only asset is their website and the intellectual property rights. Their office may be on rent, their computers, infrastructure, electronic devices may be on rental. So really they don't carry too many assets in their books. So applying book value multiple is also difficult. Generally, which model is applied in that case? Revenue model, price to sales ratio model, because at least they will have some sales. If sale is also not there, then it is difficult to apply comparable company approach. Then it is all based on the projections and judgment of the valuer. Certain examples of drivers of revenue that can be used as a basis. Very good paragraph for you for understanding purpose, because you will also probably enter into this valuation profession. One has to understand what are the key value drivers because of which the platform gets valuation. So it depends on the type of platform, which we have seen in the earlier pages. It can be marketplace. Marketplace means website which match the buyers and the sellers. So there the important revenue drivers are: how many people do the booking on this platform, how many customer come and purchase on this platform, how many registered users are there, that is those who have registered themselves with that website. When you go to a website, they will ask you, some of them will ask you to register your name, address, phone number, email. Similarly, when you download some app, you will find that in the beginning they will ask you that write your name, phone number, email ID, your age, and so many other details they will take. So that is one of the important criteria for valuation. More the registered number of users, higher will be the valuation of that platform. Then it depends on volume of transaction in that platform. If it is a payment digital platform where the person who wants to pay is matched with the person who has to receive the payment, there also the valuation depends on number of active subscribers, number of merchant registered on the platform. These companies like Google Pay, Phone Pay, they claim they have got around 40 crore registered subscribers. Each of you probably have got this Google Pay, Phone Pay, Paytm on their mobile phone. Is it right? And because of this huge number of registered customer, they are getting huge valuation. Like this Phone Pay company, the valuation is almost $10 billion now because of the huge number of registered users. It also depends on number of merchants registered on the platform. For example, the Amazon will claim we have 25 lakhs uh, sellers, vendors who are selling their product on our website, and because of that they get valuation. Then it depends on compatibility and speed of the operating system, that is how friendly your operating system is. When you go to a website, you should be able to find what you are looking for very quickly, otherwise the user will lose the patience and can go to other website. Then the security of the website is important, data should not be leaked, and then most importantly, which makes this platform popular, is the ease of use. These websites like Amazon, Flipkart, Google Pay, Phone Pay, okay, Book My Show, why they are so popular? Because of the ease of use. Then the third type of platform is community or network like Facebook, WhatsApp, Instagram, Twitter, LinkedIn, and so many other. They basically bring friends, family, relative, professionals together. Their valuation also depends on number of users. Some of them may charge subscription fees also. Okay, then there are platform for professionals. Then communication, very popular. Some of the examples are like WhatsApp, where the number of users, sponsored links, advertisement revenue, these are the value drivers. Then repositories like YouTube, okay, Netflix, Savan, Ghana, and so many, where the valuation will depend on number of readers and contributors, the authenticity of data, duration of use, quality and variety of data. So if you look at YouTube, they will say this video was searched or watched so many times, this is the average view duration, etc. All that helps you to generate value for that particular digital platform. And then search, machine queries and information. Google is one of the highly searched engines. Crores of people use Google every day, crores of people. And the popularity valuation depends on the search results also, whether you are getting the right information. Google is popular because of this, and now we have something called Chat GPT that also has started giving good search result. Then it also depends on time taken per search. How much time do you take if you want to get an information? All this goes into their valuation model. Is it right? So two examples we'll discuss. One is about search engines. How to value search engines? That will depend on the number of users, time taken, etc. So if I have to compare two search engines, let us say Google and Bing, then we will see who has got more active users, where the time required to search is lower. More the number of active user, valuation is more. Shorter the time taken for search, the valuation will be more. And now take another example of repository platforms where there is data already there, like you have YouTube where you have videos, Savan where you have music, songs, Netflix where you have videos, documentaries, etc. So how do you value them? How do you compare them? So the valuation will depend on then how many users are there, average number of views per user, all this detail they maintain, average revenue per user. YouTube is free, but they have also premium service. Then all this Netflix, Savan, they charge some amount from user per month. Then they have a list of registered users. All this goes into valuation of such repositories, right? One example is given in your book. A search engine company was valued at 100 crore, which has a 15 million users, and content of 1 lakh hours can be used to draw a comparison, while valuing a similar platform with fewer users having similar or same revenue parameters. Like for example, this company is valued at 100 crore and it has a 50 million users. So what they are actually doing, they are paying rupees 100 crore is there. So that is 1000 million. So 20 rupees the valuation done. 20 rupees the valuation done per subscriber. And another search company has only 20 million user. Another search company is only 20 million user. So this company will be valued at 400 million. Valuation can be based on number of hours which is viewed. So here it is 100 crore divided by 1 lakh hours. For a comparable company or target company, you have to see how many hours and accordingly value them. If there are two bases, subscriber and hours, you can apply weighted average. You can give weightage of 60% for number of subscriber. You can give weightage of 40% for the number of hours used. So I have prepared two examples for you, because sometimes only reading the theory is little boring. I can understand, but I can't help. This is a part of your syllabus. Solve question number 1. Solve question number 1. This question is not in any book. It has just been designed. Consider a search engine firm which has a profit before tax of 250 crore negative, but positive EBITDA earning before depreciation interest tax of 500 crore. When you go to PBT level, it is negative, but at EBIT level, it is positive. And then we have found two comparable companies. We have found two comparable companies. One is X, one is Y. Their market value of equity is given, market value of debt is given, enterprise value is given. Enterprise value means sum of these two. If in the exam this line is not given, then enterprise value in this question would be value of equity plus value of debt. And these two comparable companies have earning before depreciation, interest and tax of 400 and 520. The firm has 20 crore shares outstanding. This firm has 20 crore shares outstanding and its market value of debt is 700 crore. And its market value of debt is 700 crore. Find intrinsic value per share. Use enterprise value to EBIT ratio. So the method they have asked you to apply is EV multiple, enterprise value upon earning before depreciation, interest and tax. How are you going to proceed now? First you will find out what is the ratio for these two comparable companies. What is the ratio for these two comparable companies? Please write it down in the notebook. Please write in the notebook. Please write in the notebook. Enterprise value to enterprise value to earning before depreciation interest tax ratio of comparable firms. You can start from here because it's already there in the problem. If it was not there in the problem, then you will start from here. So I will ask you to start from here. Right hand side 2 column, enterprise value 3500, 4500. Then write down earning before depreciation interest tax 400 and 520. 400 and 520. 400 and 520. Therefore, enterprise value upon EBDIT, this is the multiple. Enterprise value by EBDIT is the multiple. So that is 8.75, 8.65, 8.75, 8.65. Because there are two firms given, nothing is given about how much weightage to be given to each firm. Otherwise, the question can say that you have to give a weightage of 80% to firm X and 20% to firm Y. But if nothing is given, you take simple average. So, average multiple of other two search engine firms is 8.75. Please check the answer. Are you getting 8.75? Are you getting 8.75? Confirm yes or no. Yes, very good. So what I'll do, I will go to the target company. The target company's earning before depreciation, interest and tax is 500 crore. 500 into 8.7 times will give me enterprise value of the target firm minus debt will give you equity value, divide by number of share will give me intrinsic value. Write down step number 2. Enterprise value of the subject firm or target firm. Enterprise value of the subject firm or the target firm. So write down the formula. EBDIT of the given firm, EBDIT of the given firm multiplied by enterprise value to EBDIT ratio, and that is equal to 500 into 8.7, 500 into 8.7, 500 into 8.7 is equal to 4350 crore, 4350 crore. Then write down value of equity, step 3, value of equity step 3, enterprise value minus market value of debt, enterprise value minus market value of debt, 4350 minus 700, that is 3650. Check the calculation, don't trust anyone including me. Is the calculation right? Please check and say yes, then we'll move forward. Is the calculation right? Very good. So that is about share value. How many shares are outstanding? 20 shares are outstanding. Write one more line. Step 4, intrinsic value per share. Intrinsic value per share will be 3650 divided by 20 crores. 3650 divided by 20 crores. How much would be the answer? Is it 182.50? Just check. I am doing directly. 182.50. Okay. So 182.50 would be the intrinsic value per share. That is the answer. One more question we have taken from some reference book. This is from reference book, not from your study material. Study material does not have any numerical question as of now. ABC Limited acquired 5% equity share of Khelo.com. Wow, Khelo.com, an online gaming company. Nowadays you have lot of online gaming company. As per an estimate, in India there are 700 online gaming companies like this Dream 11 and so many things where the student can do time pass throughout the day, okay, and lose money also sometimes. ABC Limited identified a similar nature of transaction in which PQR Limited had acquired 20% equity share in Khelo.com for 60 crore. So recently another company acquired 20% share in Khelo.com for 60 crore. The price of such transaction was determined on the basis of comparable company method, that is enterprise value to EBITDA ratio, which was 8. So this valuation has been done using this multiple. Now for the current year, EBITDA of write down Khelo.com, EBITDA of Khelo.com is rupees 40 crore. For the current year, the EBITDA of Khelo.com is rupees 40 crore. So we got the EBITDA here, and this company is valued using a multiple of 8. What will be the value of ABC Limited's investment in Khelo.com? ABC is holding only 5% share. So 40 crore is the EBITDA and multiplied by 8. So the valuation of this company will be 320 crore. Khelo.com now will be valued at 320 crore at the EBITDA of 40 crore. But ABC is only holding 5% share. They want to know what is the value of their 5% share in Khelo.com. So the answer is 16 crore. This 5% stake in Khelo.com will be valued at today's ratio, that is enterprise value to the EBITDA ratio of 8. It comes to finally 16 crore. Check the answer in your book. You can tick the answer in the book. I have prepared the answer. Determination of value of the shares held in Khelo.com. First we will see what is the EBITDA on the measurement date, 40. Then what is the multiple on the valuation date, just tick mark, 8. Enterprise value of Khelo.com. I have just changed the name for better understanding. Enterprise value of Khelo.com, 320. ABC share based on percentage of holding. ABC Limited share based on percentage of holding, 320 into 5%. 320 into 5%, and that is 16. 320 into 5%, that is 16. Is it right now? If such questions are asked, you don't have to apply something new. Already we have done in the other chapter, but the question can be in the context of a digital platform or in the context of a startup company. One more example will take that how the institute can just change the question discussed in earlier chapter in the context of startup company or digital platform companies. An analyst tracking the edutech sector. So education sector is called edtech sector because of use of technology. Like the way you are learning right now is all because of the technology. Wants to value your company, we know. Okay, we know. It is pronounced as we know. Many students wrongly call it VK now. It is we know, victory of knowledge. Using data on similar firm shown below, you have to find the value of we know. So they have found three comparable companies. This time there are three companies, so you have to take average of three companies, and the three comparable companies are Udemy, Byju, Vedantu. And what are the data available for these comparable companies? Market capitalization, PAT, sales, net worth. Based on his understanding, the analyst has decided the following. Analyst has decided that it will assign a weight of 25% to Udemy, 25% to Byju's, and 50% to Vedantu. Okay, that means this time I will not take simple average. In the question number 1 we had taken simple average. Here we will take weighted average. Point number B, since we know has a greater branding, wow, greater product range, again wow, its price multiple should be 20% higher than the industry average. So whatever weighted average you will get, for the purpose of valuation of we know, you will have to add 20% to that, because it has got a better branding and higher product range. For we know, EPS is 14, sales per share is 50, and book value per share is 160. Find out the intrinsic value per share of we know, giving 40% weightage to PV ratio, 30% weightage to price to sales ratio, and 30% weightage to price to book value ratio. Don't you think it's an interesting question? Is it right? So what I need to do, I need to first compute, this is PE ratio, make it price earning, PE. So I need to compute P ratio, price to sales ratio, price to book value ratio for these three companies first. These three multiple I need to compute for these three companies, and the data is easily available here. Then we'll compute weighted average for each of the multiple, weighted average for each of the multiple. Then we'll compute multiple applicable to we know, which will be 20% more than the average computed above. And once you have got the multiple applicable to we know, you will calculate the value of the share using the three multiples, and again take the weighted average. For the purpose of intrinsic value, the weights assigned to the three methods are 30%, 40%, 30% and 30%. There are two places where weighted average will be applied in this question. One is weighted average price to earning ratio, weighted average price to sales ratio, weighted average price to book value ratio. And then while computing the intrinsic value also, we will give weightage to the three values arrived at by three methods, right? So the question is very easy. Write down the answer. Question is not in the study material or any of the institute publication. It is from a different resource. Calculation of average price multiple for industry. Calculation of average price multiple for the industry. Under that right hand side three column, Udemy, Byju, Vedantu. These are the other three edtech platforms, okay, which are comparable. Based on their information, we are valuing, we know. So first you write down P ratio. Price earning ratio is market capitalization upon PAT. Either you can take price per share or you can take total market capitalization. In the denominator, you can take EPS or you can take PAT. Please reply. If you don't reply, I will not move ahead. First column, Udemy. What is P ratio? What is P ratio? 20. Very good. Next column, 28,000 divided by 1500. Come on. 18.67. 18.67. Next column, 18.18. Very good. 18.18. Come on, reply. Next one, price to sales ratio. Price to sales ratio means market capitalization upon sales. 20,000 upon 4,000. 5. 28,000 upon 5800. 4.83. Very good. Vedantu, 40,000 divided by 7,500 equal to, is it 5.33? Is it 5.33? Price to book value ratio. Book value means net worth. Market capitalization upon net worth. Market capitalization upon net worth. That is 2.5. 2.5. 2.55. 2.55. 2.55. Last one, 2.35. 2.35. 2.35. 2.35. Now write down average P ratio. Average P ratio. You have to apply weightage. You have to apply weightage. Just a second, please. You have to apply weightage. Please try yourself if you can. One I will solve for you, other two ratio you will solve for me. So you are given in the question the weightage to be given to Udemy will be 25%, Baiju 25%, and Vedantu will be 50%. So take the P ratio of these three companies. These are the P ratio of these three companies, and these are the weights. These are the weights. Can you please give me the answer? Can you please give me the answer? Can you please give me the answer? What is the answer? One student is saying 18.76. Very good. 18.76 is right. Try the next one. Average price to sales ratio. Price to sales ratio. Go to your previous answer. 5 into 0.25. The answer is given by a student 5.12 times. Very good. Amazing. Now you try price to book value ratio. Price to book value ratio. If you give response, I will try to find more questions and I will take. Okay. But if the students don't answer, we don't have any motivation to teach. Then it becomes like a daily duty. So the answer is right, 2.44 times. Very good. These are the three multiples. But Vino Limited says we are bigger company, we are better brand, we have more product range. So for Vino, all this will get multiplied by 1.2. So multiple applicable to Vino would be 1.2 times of industry weighted average. Write down step number 2. Justified price multiple for Vino. Justified price multiple for Vino. Under that write down P ratio equal to whatever is the industry average, I will take 20% more than that. I will take 20% more than that. How much is that? How much is that? 22.51. Very good. Come on, next. Price to sales ratio. Price to sales ratio. Take 5.12 into 1.20. 5.12 into 1.20. How much is that? Is it 6.14? Very good. Sorry, there is some problem. Okay, no problem. Now write down price to book value ratio. Price to book value ratio. 2.44 into 1.20. So how much is that? 2.93. Very good. These are the ratios applicable to the subject firm, and this will be multiplied by earning, sales, book value per share, so that you will get the value of Vino under the three approaches. Write down please. Intrinsic value of Vino. Step 3, intrinsic value of Vino. There will be three answers. There will be three answers. Based on price earning ratio, based on price to sales ratio, and based on price to book value ratio, there will be three intrinsic values for Vino. Point number A, right? P ratio. P ratio for Vino, the earning per share is 14 and P ratio is 22.51. Answer please. Answer please. 315.14. Next, price to sales ratio. Answer please. Price to sales ratio. Please reply fast. Price to sales ratio. You take the previous ratio, and in the problem sales given is 50 rupees per share. Multiply. Very good answer. 307.2. And next one, price to book value ratio. Try yourself. Try yourself. Price to book value ratio. $2.93 into 160. 468.8. 468.8. Very good. This is also not final. These three intrinsic values will be applied certain weightage. So please write down. Therefore, intrinsic value per share equal to how much weightage will be assigned to P ratio? 40%. So you will take 0.4. How much weightage will be assigned to by this second one? 30%. 30%. So take 0.3. And how much will be weightage for the third ratio? 0.3 again. Solve. Solve and give me the answer. So one student has replied, let us check. Very good, 358.80 or 85 is right. So these are three questions I have found from other resources and we have added it. It may be little relevant in the context of this chapter. Next method of valuation of digital platform is cost approach, is called cost approach. So what do we do under cost approach? The cost approach means, as the name indicates, how much is the cost of building that platform or similar platform with the similar utility. So here we are focusing only on the cost part. Suppose the cost of designing that website is 20 lakh rupees with all the features in that website. Okay. So as per this approach, we'll say the value of this digital platform is 20 lakh. The logic is that the asset behind the digital platform is the code written, the number of hours spent to write the code by the developers is the primary cost of the platform. So you can simply say all costs which have gone into development of that digital platform is the value. Now you will respond, is it an appropriate method of valuation? Is cost approach an appropriate method of valuation? The answer is no. Cost method is not an appropriate method of valuation for something like digital platform where cost is not very important. The idea is important. The future revenue potential is important. The future earning potential is important. And that should be taken care of in the valuation, which is not happening in case of cost model. So this is the drawback of this cost approach. So that completes the digital platform valuation. They have also added one more area of valuation called valuation of professional or consultancy firm. That is how the CA firm, how the lawyers firm, architect firm, okay, or medical professional or engineering services or interior decorator, teacher, how they are going to be valued. Firms which are providing customized or knowledge based service to the client are called professional or consultancy firm. These provide knowledge based service like you, chartered accountants, full of knowledge. I don't know how much your brain can store so much. How can your brain store so much of knowledge? I am surprised. You know about law, audit, tax, FR, AFM and so many other things also. So chartered accountant brain, I believe, must be little bigger than the other people. Then there are advocates. Oh my God, they are even bigger. Is it right? They remember all the section law, case study. And then there are management consultancy firm which give consultancy to businesses about several strategies, mergers, acquisition, demerger, valuation, restructuring, etc. Each consultancy firm is different. The services provided by chartered accountants are altogether different from the services of advocates or architects, and therefore one has to understand different business model and their key parameters, key performance indicators that goes into the valuation of such consultancy firms. So as per the notes provided by the institute, the method for valuation of professional or consultancy firm is one, current industry benchmark and KPIs. KPI means key performance indicators. So how the industry benchmarks the firm on certain parameters, you will take those parameters and value the firm accordingly. Second is, as usual, for all other methods we have seen comparable company approach, and the third one also we have seen under other approaches called income approach. So very quickly we will just discuss the three approaches. One is current industry benchmark and KPIs. So one of the commonly used method to analyze the extent that a firm meets expectation in comparison to current industry benchmarks and KPIs. So if you have to value a particular firm, you have to see what are the standards of that industry, KPIs of that industry, and to what extent this company is able to match those KPIs. Since professional firms are different, KPIs can be different for different industry. Is it right? So one has to look at the specific indicators which align with acquirer firm's goal. So as an acquirer, what are you looking at? Which key performance indicators you are looking at? For a CA firm, how many clients they handle, or how many listed companies do they handle, how many audit report has under peer review got some kind of negative remark. This can be KPIs. In case of legal firms, they can check how many cases do they win, the percentage of success, etc. So those can be KPIs. I don't know about so many other professional activities, so I can't give much comment about it, but yes, one has to look at the key performance indicator. Based on that, you will benchmark and do the valuation. Understanding the present and projected industry trend also an important factor in determining the value. Which direction the industry is going? Is the industry growing, or is the industry stagnant, or is the industry decline? All these factors you have to take care while doing the valuation. One can also look at the firm's historical data to compare with the industry key performance indication and benchmark. So what is the summary of this? Look at the industry KPI, look at the firm's achievement with respect to those KPIs, and accordingly the valuation will be done. Another model on which our institute has not given much stress, and that is called compare the company against its competitors. So identify who are the competitors and get the information about the competitor from annual audited statement, tax return, etc., and then use that value for the purpose of valuation of the target company. Now next is income approach. Again, under income approach, there is nothing new to be explained. You have to find out the future maintainable profit or future cash flow, terminal value, and do the valuation using same methodology which we have already explained to you in the main chapter of business valuation. Only some hint they are giving, but that also we have already discussed. And what is that? If your income contains some abnormal item, extraordinary item, non-recurring item, then those items will be required to be added back. Those items will be required to be added back. Okay? Like for example, there can be loss due to fire, that can be added. There can be some non-cash item that can be added. Once you get the normal cash flow, ignoring the non-cash, ignoring the abnormal items, you get the normal cash flow, then you can use that normal cash flow for the purpose of valuation. Now the student will ask, what are the limitations of income approach? What are the limitations of income approach? The limitation is that it depends to a large extent on the projection of the future earning, future growth, future terminal value, okay, and there is an inherent risk associated with using future earning potential, because future is uncertain, and to the extent your future earning may not be materialized, your valuation can go wrong, and there is always this inherent risk that future earnings may or may not materialize. So while doing valuation, keep in mind future earnings cannot be realized, and that should be factored in the valuation. So either you may adjust the future cash flow or you may adjust the discount rate for the purpose of valuation. So this is about professional and consultancy firm, and in this chapter, in the last part of this chapter, they have added something called impact of ESG on valuation. Impact of ESG. Do you know the full form of ESG? ESG means environment, social, governance. Nowadays, globally, many governments, organizations, businesses, corporates, okay, they are trying to give importance to these three important aspects: environment, social and governance, which means the firm should also make strategies, plan its business, keeping in mind the three factor ESG, such that all the stakeholders who are associated with the business should be benefited. The different stakeholders in a business are not just the owner, but also the employees, customers, suppliers, financiers. You must earn the profit, nothing wrong with that. But while earning profit, one has to also take care of environment, one has to take care of social issues, and one has to take care of governance issue also. Lot of focus is going on governance because corporates are using public money. We have a trust on the corporate. We expect corporates to behave in a certain manner. Corporate should exist for its stakeholders, not for the benefit of the few promoters or few shareholders. So this is an interesting chart. It gives you what are the contents to be included in the three factors. For example, this list is not exhaustive. For example, climate change. Under environmental, you have to see climate change. Will your decision have an impact on environment like climate or water, waste generation, emission or biodiversity? These are some of the environmental related factors. Many investors do not give fund. Trust me, if your funds are going to be used in projects which can cause damage to the environment, some time back I read in the news, in Norway there is a Norway sovereign fund which was about to provide financing to Adani Group, but they have not provided the funds because these funds were going to be used in some projects which will cause harm to the environment. Right? Even the governments and the international bodies nowadays, before they are lending money, they will make sure that these funds will not be utilized for projects which might be harmful for the environment. As we can see around us now, the weather is changing in a very uncertain manner. Sometimes there is rain, sometimes there is extreme heat, sometimes there is flood, sometimes there is drought, and there is no right way of prediction. All this is happening because of the damage caused to the environment. Therefore, Even the lenders and investors have become conscious about protecting the environment, because if the money goes in projects which will cause damage to the environment, it is not a good investment. Okay, next is what issues are covered in social aspect: employment development, diversity and inclusion. That means people of different strata of the society should be brought in the organization. Male female ratio must be properly balanced. Okay. Community development. Even now our parliament wants that 33% of the parliament should be occupied by women to have a proper diversity and proper representation in the parliament. If the government can think, why not corporates can think? Community development, then you have to also take care of health and safety, and you have to also take care of the welfare of the customer. You don't have to only extract money from the customer, you have to give him proper services. Then what are governance issue? Board independence. Lot of importance have been given to independence of the board. In your corporate law you will study, or you might have studied, a certain number of independent directors must be appointed on the board. Board diversity should be there. There should be enough number of female or women directors also on the board. Then there must be proper anti-corruption and anti-bribery mechanism. Corporate should not be involved in that. Tax transparency should be there, and they should conduct business ethically. These are governance issue. How does it impact valuation? The question is why we are discussing it. How does it impact valuation? Investors have started focusing on ESG now, and they are giving funding to companies which give importance to ESG. And if the company is not giving importance to ESG, they may not get the funding. Key environmental aspects under consideration are climate change, natural resource scarcity. It covers social issues like diversity, inclusivity, labor practice, health, safety. This all we have discussed. Now, not only investors, there are different agencies, organizations, they have given importance to ESG now. Even if you read newspaper, you will find somewhere in some corner some news on ESG would be there. Okay. So there is a tremendous momentum in the whole ESG game plan, and the summary of key developments are that investment in ESG fund has grown to $50 billion in 2020. And total asset with ESG focus crossed more than, oh my god, $35 trillion in the same period. Then green bonds, many governments are issuing green bonds, corporate are issuing green bond. Sir, what is green bond? Green bond means the funds are used in projects which are environmental friendly. Funds which are used for projects which are environmental friendly are called green bonds, and the amount of fund raised from green bond has crossed $1 trillion. Can you believe that? Then sustainability taxonomy on the rise. Key regions have already defined sustainable taxonomy. Like different regions have defined what are the important aspects to be covered in ESG area. Like European Union has defined. Other countries and regions have also started laying down the rules, the parameters for ESG. And what is the next? Even the IFRS committee is now planning to bring a single reporting standard on ESG. Very good. Why we should be left behind? Our SEBI has also proposed a regulatory framework on ESG disclosure by listed companies. So SEBI is also thinking of bringing that in the annual report of the company, they must give some disclosure about their ESG compliances or what they have done on the ESG front. So, impact of ESG on valuation: companies should be able to raise funds if they are good with ESG. Investor, lenders, financial institutions, they also prefer to lend funds for ESG companies. As I told you, there are some instances where certain investors have stopped funding to certain business houses when they found that they are not in compliance with ESG. Another benefit of ESG compliance would be company will be able to obtain funds at a lower cost. Investors don't mind putting their money in projects which will have lower damaging impact on the environment, and therefore they are willing to invest in such projects at a lower cost also. So this will help them to raise money through green bond, social and sustainability linked bonds. Traditional belief was that ESG was good to have. Till yesterday we were believing it is good to have ESG. Now we believe that it is must to have ESG. So the luxury has become necessity now. The luxury has become necessity. Your mobile phone, which was luxury 20 years back, when somebody used to walk with a mobile phone, we used to look at with awe. Wow, this fellow has got mobile phone. Wonderful. If he has got BlackBerry, he's a great man. Now who bothers? Every second fellow is walking away with all Apple phones and nobody bothers to have a damn look. It has become a necessity. Similarly, ESG has become a necessity. It is must have item. Okay. The business case for ESG generally begins with operational efficiency and risk reduction as primary goal and then extends to long-term operational and organizational resiliency and sustainability. You will not be able to read and remember such lines. Okay. Only thing you have to write in the note: investors give funding to companies which are ESG focused. They are able to raise funds at a lower cost. If the company focuses on ESG, they can raise funds by green bond, socially sustainable bonds, etc. They will be in the goods books of the regulators also, in the investors also. They are liked by the investors community. Next point is, somewhere in your book, how the risk of ESG factor can be incorporated in the value of business. How the risk of ESG factor can be incorporated in the valuation of business. So the answer is, if you find that corporates are not fulfilling ESG obligations, either you have to adjust their cash flows or you have to adjust their discount rates. So this way ESG factors can be incorporated. One popular is increase the rate of discount. Increase the rate of discount. So if you think that ESG risk is more, company is not complying with ESG, then you can use a higher discount rate in the valuation. Okay. Or the other option is you can adjust the cash flows. You can adjust the cash flows. For a risky cash flow, how much is the equivalent risk-free cash flow, and that way the risk can be incorporated in valuation when ESG compliances are lacking. How the impact of each factor, can be incorporated in computation of expected cash flow. The last part of this chapter is how the impact of each factor can be incorporated in cash flow estimation. So there are three terminology they are using. ESG. E stands for environment. Okay. So you have to see how much damage or the environmental risk is there because of a certain project. Example, if temperature of the plant is increased by 2 degrees, how will it cause impact on the environment, and accordingly the cash flows can be adjusted. Similarly, adjustment in cash flows can be made by considering carbon points, how much carbon dioxide you are releasing, that is carbon point, and accordingly the cash flow can be adjusted in case if there is a damage to the environment. S stands for social. That means we will consider how many good steps have been taken by the company for the welfare of the society. For example, have the company worked on labor welfare? Have the company worked on CSR and other welfare activities for various stakeholders? If the answer is yes, company has been doing good job with respect to labor welfare, CSR expenditure and the welfare of other stakeholders, you can have a positive impact on the cash flow. And what is G? G stands for governance. Governance means you have to see, is the company following the corporate governance standard? If the governance standard is poor, like company has been avoiding tax, company is not ethical, company is paying fines, penalties, taxes, then cash flow would be lowered. But if the company is having strong corporate governance, company completes its duties ethically, morally, the cash flow can be increased also. This way the cash flows can be adjusted for different factors. So thank you very much for attending this chapter.